All right, let's get right into it. Welcome to our Deep Dive Explainer, where we're going to investigate one of the most famously misunderstood retail giants on the planet. We all know the name, right? Millions of us shop there every single weekend. But the economic engine running quietly in the background is far more fascinating than you might think. For decades, traditional investors have scratched their heads at how this company operates. I mean, they doubted that a business built on practically giving away merchandise could ever survive, let alone dominate. So today, we're going to decode that massive secret. We're going to look right past the pallets of paper towels to uncover a true economic juggernaut.
So I want to kick things off with a simple but kind of provocative question. What does Costco actually sell? When you close your eyes and picture a trip there, you probably see exactly what I do. You know, the mildly chaotic parking lots, the giant concrete aisles stretching out endlessly, the impossibly oversized shopping carts, and of course those massive tubs of mayonnaise. It's a very specific physical experience. But if you think the merchandise sitting on those towering metal shelves is their main product, you're completely missing the real genius of their strategy.
Just think about the staggering scale of their financials for fiscal year 2025. We are talking about over $275 billion in revenue. To put that into perspective for a second, that is roughly equivalent to the entire GDP of a country like New Zealand, or on par with the revenue of some of the most famous tech giants in the world. They operate 931 massive warehouses all over the globe, moving just an unimaginable volume of physical goods every single day. The logistics of moving hundreds of billions of dollars of bulky items is a monumental challenge. But here's the ultimate twist. Despite this massive retail footprint, the merchandise itself isn't their true product.
Here is the punchline, and honestly, it's the secret to their entire empire. Costco is not fundamentally a traditional retailer. They are a subscription business masquerading as a grocery store. If you want to understand how they conquered the retail world, you have to completely shift your mindset. We have to stop looking at this through the lens of retail economics, where profit comes from selling physical items, and start looking at it through the lens of subscription economics, where profit comes entirely from loyalty and access. Chapter 1: The Great Retail Misunderstanding. To truly appreciate Costco's unique playbook, we need to understand how traditional retail is supposed to work. The normal premise is pretty simple. A store buys goods for cheap from a supplier, they mark up the price as much as the market will tolerate, often 30, 40, or even 50%, and they pocket the difference as profit. Now, contrast that with Costco. In 2025, Costco's overall gross margin was a razor-thin 11.12%. To an uneducated observer, low single-digit margins on physical merchandise? That looks like financial suicide. It would bankrupt almost any normal retailer. But they aren't trying to squeeze every last cent of profit out of the items you put in your cart. Their deliberate strategy is to return the gross profit right back into shelf prices to give you, the shopper, the absolute best deal possible.
And there is absolutely no better visible proof of this strategy than the legendary $1.50 hot dog combo at their food court. That price has remained completely unchanged since 1985. No way, right? But it's true. It's not a mistake, and it's not just some cute gimmick. The famous lore goes that Costco's founders outright refused to raise the price of that hot dog despite decades of inflation, recognizing it as a symbol of their promise to the consumer. It represents their absolute, almost fanatic discipline. They deliberately sacrifice merchandise margins to offer unbeatable value, building this immense wall of trust with the shopper that competitors literally cannot replicate.
Chapter 2: The Real Business Model.
Because they aren't marking up the groceries. The obvious question is, well, how on earth do they make any money? We just talked about that jaw-dropping $275 billion in total revenue. But since those grocery margins are so insanely thin, they don't leave much leftover cash at the end of the day to run a global empire. So to figure out how that massive revenue translates into actual, sustainable profit for the company, we have to stop looking at the shopping carts entirely. Instead, we have to look directly at that little plastic access card sitting right there in the customer's wallet. That access card is the real product. Today, there are 147 million Costco card holders globally, and every single one of them pays an annual fee, usually between $65 and $130 a year, literally just for the privilege of walking through the front doors. Think about the psychology of that for a second. Why are 147 million people willing to pay a flat entry fee just to go inside and spend more money? Well, it's framed as an exclusive club, where the entry fee easily pays for itself in savings. They aren't selling you groceries. They're selling you the right to buy groceries at cost.
We talk a lot today about the subscription economy. You know, Wall Street loves software as a service companies, and we're all totally accustomed to paying monthly for Netflix, Spotify, or Amazon Prime. But Costco instituted this physical membership fee model way back in 1983. They were pioneering the recurring revenue model in the real world, decades before tech companies and streaming giants made it the hottest trend in business. They were the original subscription service, and they did it with physical merchandise.
Let's dive into Chapter 3, Following the Money.
When we look at exactly how this subscription fee dictates profitability, the sheer brilliance of the Costco model comes into sharp focus. Just look at the breakdown. Those annual membership fees, which only cost the consumer a small amount per year, generate roughly 75% of Costco's total operating income. Let that sink in for a moment. 3/4 of their operating profit comes directly from the membership fees. Their bottom line is almost totally insulated from those razor-thin margins and the chaos of the merchandise side. The retail operation is essentially just a break-even mechanism designed to drive membership renewals.
The crucial point here is how they cultivate the highest value tier of these subscribers. Their executive members actually pay a higher $130 annual fee in exchange for a 2% cashback reward on purchases. This is a remarkably gamified ecosystem. They incentivize their highest spenders to pay double just to get a rebate, essentially locking the consumer into shopping at Costco for absolutely everything in order to make their money back. And it works beautifully. These shoppers are fiercely loyal, and as of 2025, this specific group generated an incredible 73.6% of Costco's worldwide net sales. They are the ultimate super users.
Chapter 4. The Cost of Low Prices.
So how does Costco actually afford to maintain this low-margin, high-value ecosystem without the whole thing collapsing under its own weight? Well, it requires ruthless operational discipline, starting with the paradox of choice. Think about a traditional supermarket for a second. It has a dizzying assortment of around 40,000 different items, overwhelming you with options. Costco, on the other hand, carries a ruthlessly curated selection of just about 4,000 items. You don't get 20 choices of toothpaste, you get 1 or 2. Costco makes the choice for you, acting as a curator. This drastically reduces decision fatigue for the buyer and creates incredible leverage for Costco in negotiating with their suppliers.
By stocking fewer items, Costco creates massive volume per item. Let's break down exactly why this matters using a simple principle. This concentrated volume allows them to turn over their entire inventory 12 to 13 times a year. They sell through physical goods in roughly 27 to 30 days. Because things fly off the shelves so incredibly fast, they essentially sell the ketchup and put the cash in the bank weeks before the bill from the ketchup supplier is even due. It is basically a negative cash conversion cycle, an incredibly efficient flow of capital that funds their growth without them ever needing to borrow money.
And actually, there is another massive operational advantage hidden right in plain sight. Unlike a lot of their retail rivals who are plagued by crippling lease agreements, at the mercy of greedy landlords, or suffering from rising commercial rent prices, Costco owns most of its warehouses outright. They sit on roughly $30 billion in net property and equipment. By owning the dirt beneath their feet, they drastically reduce their overhead and build a massive competitive moat. They insulate themselves from macroeconomic factors, meaning more predictable costs and more savings they can pass directly on to you, the subscriber.
Chapter 5. Why Wall Street Loves Costco.
Because of this highly unique, highly efficient hybrid model, Wall Street treats Costco very differently. The stock market values Costco in a way that is practically unheard of for a retail grocer. To understand Wall Street's obsession here, we quickly need to define the PE ratio, or price-to-earnings ratio. In plain English, this is simply the amount investors are willing to pay today for each $1 of a company's annual earnings. You can think of it as a metric of future trust, a gauge of how much investors believe in a company's reliability and growth over the long haul.
Currently, Costco trades at a massive 47 times PE premium. To give you some context on that, that is a valuation usually reserved for high-growth, flashy technology companies. From a traditional finance perspective, it makes absolutely no sense to award a 47 times multiple to a company selling rotisserie chickens, cheap gas, and bulk toilet paper. But the market isn't confused. They appreciate the irony, and they know exactly what they're buying.
As the NASDAQ index report noted perfectly, what the market is paying for is a renewal rate held above 90% for more than a decade. Wall Street isn't paying for grocery margins. They don't view Costco as a traditional retailer at all. They view it as a bulletproof subscription utility. They are paying for a predictable, recurring cash flow that behaves exactly like a highly successful software company, rather than a supermarket subject to the whims of consumer trends.
And that loyalty? It's truly staggering. In 2025, their membership renewal rate in the US and Canada was an astonishing 92.3%. More than 9 out of 10 people renew every single year, A massive driver of that trust is their private label, Kirkland Signature. This private label alone generates more revenue than many famous standalone brands. It keeps members coming back because the quality is often better than the expensive name brands, solidifying that incredible 92.3% renewal rate and proving the unbreakable strength of their ecosystem.
So I want to leave you with this final thought to rethink your next warehouse run. We started this explainer looking at a seemingly misunderstood grocery warehouse. We've uncovered a finely tuned, subscription-based economic juggernaut. The next time you flash your cart at the door, remember, you aren't just a shopper in a retail store. You are a recurring subscriber, funding one of the most brilliant and disciplined economic engines ever built. Thanks for joining me on this explainer, and as always, keep asking the big questions.